Hello, everyone. Welcome to today's webinar, right? So the shifting landscape of the non-trade REIT and the general and alternative market in general. So first and foremost, thank you. Really appreciate all of you for giving me 1 hour of your time to join this webinar, where we'll talk about alternative market in general. No, we will not talking about Bitcoin, which I don't know much about. So we'll cover more about non-trade REIT and other alternative and retail channel in general. So I hope all of you are excited about this topic, because I'm really excited as well, right? So especially with our guest, right? So we're joined today by Kevin Gannon, Chairman and CEO of Robert A. Stanger & Company. Kevin is definitely one of the most recognized experts in both security and valuation matter. He has appeared as an expert in numerous forums, right? So especially regarding this topic on trade REIT, alternative market, we will talk about today in general. So if you ask me who you should reach out to, besides Altus, right? So when you're trying to form an NTR about this market, I will say Kevin and Stanger, right? So Kevin joined Stanger in 1983 and has been the lead and co-lead investment banker for more than $100 billion per signing. So thank you, Kevin, for joining us, right? So, and thank you as well for providing most of the data in the presentation slide deck today. So joining from Altus, Ted Kling, Director at Altus, she oversees monthly valuation process for multiple non-trade REIT. So she has more than 25 years of experience, expertise spent on industrial, retail, office, multifamily, and specialty properties. Any property type, name it, she knows them all, right? So looking forward to learn from them as well on valuation and process best practice for non-trade REIT. And myself, Robbie Danjong, I lead the valuation advisory service group globally. I've been involved with basically, I've been involved most of the non-trade REIT clients since inception, right? So providing market insight, or presentation, general advice regarding valuation and valuation policy in general, right? So, but before we start, I'd like to cover a few housekeeping items. The first one, if you have any questions throughout this webinar, please submit them in the Q&A box. If time permit, we will try to get to a few of them, right? So if we don't, we make sure someone in our team will reach out to you post this webinar. Second, today's webinar is being recorded, right? So, and everyone who registered for today's webinar will receive an email with a link to view the recording. Should you want to reference it later or pass it along to a colleague that could not attend today's event, so stay tuned for that email. So we'll start. So I think that the first one, basically, Kevin, right? So thanks again for joining us, right? So I know non-trade REIT have been a growing interest in the industry. I know your company and your reputation in the industry, but I know that many of our clients might not be aware of the company, right? So I think it's very beneficial for them to reach out to you if they're trying to form an NTR. So can you talk a little bit about Stanger, like so what you guys do and how you can help our clients?
Sure, Robbie. We've been around for quite a few years, since 1978. I joined the firm in 1983, so I'm here 42 years. Hard to believe. 42 years of working here. We're an investment banking firm. Fundamentally, where we make our money is in mergers and acquisitions, helping people merge companies together and get them prepared for a listing. That's kind of what we do. We've done $100 billion of those kind of transactions. I've done all of them. I've done every one of those deals. So it's been a good education and a lot of fun, really. Securities valuation work, we track data on about 25,000 non-traded securities, and we report them to banks, trust companies, clearing firms, et cetera, for carrying them on account statements. There's others that do it. We think we're among the biggest that do it. 25,000 securities we track. We also do appraisal work. We compete with Altus at a very low end of the spectrum, but we do some valuation work for non-traded REITs and NAV REITs and lifecycle REITs. And we do $20, $30 billion a year of real estate and debt. And the reason we do that isn't so much because of the money we make doing appraisals. We do it for the chops it gives us doing an M&A trade. When we're up against a big firm and my guys have kicked the bricks, seen the property, loaded the leases into Argus, and looked at the sale comps, the rent comp. Well, we got a real good understanding of the real estate. That's why we do the appraisal side of things. We also help people look at entering the non-traded REIT space and other alternative space. We help them understand it. We help them look at it. I'll show you in a slide in a couple of minutes the different things that we do, but we help them understand it. And many of the players that have come into this space have come through my office because we give them the background on what's going on, what the competitive set looks like, how they perform, what the fees out of them are, how they need to perform, how much money they raise, how much redemption activity. We track all that stuff. We do lit support. That's kind of a sidebar thing. And personally, I do all of that. And I like doing it because it kind of keeps you on your toes. When you're dealing with, when you're sitting on a stand explaining something, you got to know what you're talking about. And it helps you when you're talking to boards of directors, et cetera, when you have the experience in appearing in Delaware Chancery Court, U.S. Tax Court, et cetera. Those are very helpful. Then the publications, most people know us for our publications. If you can click to the next slide, it just shows a couple of publications. We publish the Stanger Market Pulse, which tracks fundraising on all alternatives, non-traded REITs, BDCs, interval funds, DSTs, et cetera, infrastructure deals. So we're tracking all the fundraising in the Market Pulse. In the Stanger Chairman's Report, we're tracking not only fundraising, but we're tracking redemption activity. That's the coolest thing that's happened in this space in the last 7-8 years, that redemptions that have been met, huge amounts of redemptions have been met. It has really changed the appearance and the acceptability of NAV REITs in particular. And it's worked really well. The Stanger Report tracks the fee structures and the performance of non-traded REITs and business development companies. And it's a one-shot deal. You can see everything you want to know about a fund, how they're structured, what the fee, different classes of shares are, what the fees are, et cetera, and then how it performed. We track the performance of not only the REITs and the BDCs, but we do it for the industry in the aggregate. We look at aggregate type indexes that we create. That's kind of cool. And then the interval fund report, we're doing the same thing with interval funds, tracking the existence of the deals, their fee structures, how they're performing, et cetera. The Stanger Private's a new publication just came out. So much activity has moved into private markets nowadays that we've got about 100 private placed securities that are publicly reporting. Okay, they report publicly, but the issuers themselves are issuing securities privately, 506B or 506C deals, and that's been a big growth area in our space in terms of activity, in terms of fundraising and the appearance of new deals. And the Stanger Digest is something we put out for free every week to people to tell them everything that's going on in this space, all the different filings, and in 10 minutes you can get a whole view on everything going on in the alternative space, non-traded REITs, BDCs, interval funds, et cetera.
I completely agree, Kevin. I think I follow your publication religiously as well, right? So every quarter, the first thing I open is to see the market pulse, what is that coming, kind of all the other stuff. So, and then the chairman report just came out today, right? So I think that, I know it's part of a slide deck, but it was again, I found it to be very insightful.
Yeah, that's good. I appreciate that. Thank you. I said before, we help people figure out how to enter the space. First thing we do is figure out what you know how to do. What do you know how to do? What are you good at? And what do you do that might be sexy out there, might be cool to show, something different, something niche, right? We help people figure that out, whether it's real estate, credit, energy, infrastructure, private equity, tax deferral with DSTs, or multiple strategies, right? And then we look at structure. What are the structures you can use? A NAV REIT, a traditional life cycle REIT, a business development company, a 40 Act product like a tender offer fund, interval fund, a Delaware statutory trust, private placements of all the above, because everything's being done as a private placement these days, and other products. So now we figured out what you can do, how you should package it. Then we shall help you figure out how to distribute it. How do you raise money for that product, for that investment thesis you have? And do you build your own program? And how big of a distribution arm do you need? You form your own broker dealer and load it up with wholesalers and senior execs and go out and do it yourself. Do you do it with somebody else and share the fees with somebody else? We show you how to do that, the capital requirements of it, how it's going to work, how you get into the various distribution channels, wirehouses, RAAs, and IBDs, and then what the revenues and expenses are, because it's complicated. And there's a lot of moving parts, and we think we know the moving parts, so we can help you figure that out. It's kind of a fun, interactive process that we get involved in.
Perfect. Thanks, Kevin. I'll kind of flip back to you, right? So I know you are very active in valuation, in Altus valuation management, in our role as kind of independent valuation advisor for many of the non-traded REITs, right? So roughly, how many non-trade REIT that Altus is working on? Is it all equity or is it also credit? And I know that we talked about before, there's definitely a lot of overlap with Standard client and Altus client, right? So.
Hey, Robbie, thanks. And happy to be here to talk NTRs, which has been my primary focus for the past several years. First things, when I looked at Stanger's client list, the first thing that popped out of me was that we overlap clients. We currently, as you can see here, we currently manage the valuation process for 20 plus NTRs, equity and credit. We currently are in talks with several more. Assets are located throughout the United States, Canada, and Europe. Our clients have NTRs that are diversified as well as single sector focused. Altus is responsible for the valuation advisory, either internally or managing the external review of over 5,000 assets per quarter with over 150 billion under valuation management. So as you can kind of see here, Altus has significant experience in this arena, and it's only growing.
Yeah, I know like the 150 is big, but I know there's only a smaller portion of our total. We handle over 1.1 trillion on a quarterly basis, right? So it is a growing sector. Like, so I agree. That's the reason for this webinar, right? So, and I know before we go to the meat and potato of the overall discussion, we'll go to the first poll, right? So I think the first poll is like, which best describe your firm involvement with non-traded REIT, right? So are you currently operating an equity NTR? Are you operating a credit NTR? Do you operate both? Or do you consider launching an NTR? Or then the last one, you do not operate an NTR, right? So I'll let maybe like a 30 second or so, for people to answer. Deb, your thought, like basically an audience. I know that we have close to 1,000 people registered in here. So what are your thoughts? Is it a lot of people, the first 4 category or the first 3 category, do they have it? Or they're kind of considering maybe the 4th category?
I would say maybe quarter of people maybe have NTRs, looking to learn a little bit new, and then the bulk of it would be that considering launching an NTR, and this would be, obviously a great place for them to start. And then between equity and debt, not sure. I'd vote probably more equity.
Yeah.
The only thing I'd add to that is we have met with 160 different prospective sponsors in the last 2 years. 160 in the last 2 years. I didn't see 160 in the prior 40 years with the firm. 160 in the last 2 years. So it's become such a credible industry with the transparency on valuation, much to the credit of Altus, and the liquidity features, right? It's really it's really evolved in a great way.
Okay, Robbie, so we've got results. I was sort of close. We operate an equity NTR, 28%. We operate a debt/credit NTR, 1%. We operate both equity and debt and credit, 10%. We're considering launching an NTR, 17%. And 44% we do not operate NTRs, which I did not see as an option there. So interesting.
As of tomorrow, that'll all change, though.
So, Kevin, I'll flip to you now, right? So basically, we know there's have been a large capital raise in NTR over the past 5 years. So I think the first thing people said, what is the size of current? I know we talk about NTR, but it's kind of like an equity NAV REIT. Right? So there's multiple name to it, right? NAV REIT or like NTR, right? So we've talked about this stats, Kevin, like 199 billion, 92 billion. And I know that I look at the next slide, that's kind of close to 100 billion raised the last 5 years in NTR. So I'm assuming it's pretty minimal 5 years ago then, right, Kevin?
Yes, the NAV REITs, here's kind of how it evolved. Originally, there were what we call life cycle REITs, which were intended to raise money and run for 5 to 7 years, then liquidate or list or merge, right? And so that's one class of REITs. They raised, those deals raised a little over $100 billion in the early part of the last decade or so, the last prior 15 years. In the last 6 or 7 years, with the onset of JLL and Blackstone and Starwood and a few others, we've raised over another $100 billion in capital over the last 7-8 years. Right now, today, there's about $78 billion of publicly registered NAV REITs, $78 billion of equity today. That's net of all the redemptions the last couple of years. Additionally, we've morphed into doing private placements of the exact same security. So they're publicly reporting companies. They file 10Qs and 10Ks, but the offering itself is a 506B or 506C, and it's a private placement, and they're raising money that way. and they're starting to gain some traction. They're 14 billion so far, so combined it's 92 billion, about 50% leverage right now today if you looked at it across the whole spectrum. And their performance has been a little choppy recently as prices have corrected, right? We've seen in the last 4 years, we've seen the Fed funds rate go up 400 basis points. We've seen interest rates for debt of this sort go up 250 basis points. So guess what? Real estate values leveled off or came down, and that impacted the NAVs of these deals. So you see total returns are a little bit lighter. You go back 5 years, the 5-year total returns about 8%, so more respectable, but the last year or two has been caught up in some value corrections, which you have to do. You absolutely have to do that.
Yeah, I think on here as well, the one thing a lot of people questioning it, but you have to look at the property mix, right, Kevin? If you look at it, 75, 76% of basically allocation is residential industrial. They actually perform well, fundamental, right? So, and then now you get the data center. I don't think the private real estate or any public REIT have that big of a size, a percentage of 8.1% from data center. They have a lot of development component to it. And then the one thing that I kind of said that the office has always been a negative issue, right? So it's only 4.7% in the REIT, right? Yeah. So in the net REIT. So I think that's kind of one thing that people don't realize is like they don't have too much exposure to the office, right? So they have decent amount of exposure in data center, and there's a lot of exposure in residential, industrial that perform well the past 5 years, right? So
it certainly didn't hurt performance of this space that they focused on multifamily and single family and industrial. Those two categories, did pretty well the last several years. So no one's complained about that. Where before that, in the life cycle REITs, very often they were dominated by office. Very often dominated by office. So they got banged up pretty good. In 2008. I mean, it was pretty tough going. And so that's kind of what happened. So they were smart, and it was led by the likes of JLL and Blackstone and Starwood. They jumped in heavy on multifamily and industrial, and turned out to be the right strategy. And the way I look at it, that's kind of what you're paying for with these NAV REITs. You're paying for that market intel from big players who advise institutions on where they should put their capital, right? I think that's part of the intangible that comes with these NAV REITs, for sure.
Sure. Yeah, I think the next slide is very interesting to me, right? So I know that people talk about the challenge in raising capital, right? So, and this slide showing the alternative market fundraising, 138 billion in 2024, Kevin. Like, so 175 billion run rate for 2025. That's just baffling. I understand the MTRs have declined, but technically, as you mentioned, the MTR moved down to basically the private placement on the REIT side, right? So they're actually not really declining in 24 compared to 23, but it's still a massive number. So I think that's why people should consider this strategy. So
I think the way to look at the slide really and the data is to say that, hey, this alternatives were 31 billion in total in 2020. And it went to 89 billion, 111 billion, then 83 when we had interest rates rising, right? 138 last year, and we said, like you said, up another 26% this year to 175 billion. And what's beautiful about the NAV REIT today is it's structured in such a way that it's transparent. First and most important, everybody knows what the value is every month, right? You know what the value is every month. So you got a third party, an Altus, who dominates the market, a third party confirming value or setting the value, number one. Number two, you got that liquidity feature, which is a liquidity redemption feature that's up to 2% a month and 5% of outstanding per quarter, and that's been huge. Everyone, they redeemed a lot, and guess what? People felt good about it. It really legitimized the space like it's never been legitimized before. So that's why you see the run up in all alternatives, and it's moved around from non-traded REITs to business development companies and interval funds, and most of that movement has been yield oriented. The non-traded BDCs and interval funds have higher yields than the non-traded REITs. Preferred stocks too have non-traded preferreds have a higher yield also. And then the other categories I think are more people looking for other alternative solutions. Private equity, infrastructure, other credit, other real estate, miscellaneous categories. To me, this whole story is about two things: transparency and liquidity. And thirdly, I think it's the answer to the turbulence in the stock market. When the stock market's got turbulence, the non-traded REIT and the alternative market takes off. We modeled the VIX versus fundraising in alternatives, and there's an absolute correlation between the volatility as evidenced by that turbulence in the VIX, or that what the VIX demonstrates to be turbulence, and fundraising in our space. And if you believe, as I do today, that the market's going to be turbulent for at least the next 4 years, it's going to be turbulent. Whether, I don't care if you're a Democrat or a Republican, it's going to be turbulent, right? With that turbulence, this space is going to continue to take off. And the only thing stopping non-traded REITs from getting back to be the top dog is interest rates. Right? We'll get interest rates to straighten out relative to cap rates. We'll be back doing positive leverage deals again, and it'll be rock and roll, and we'll see some monster numbers. We think this 175 billion goes to 200, 250 billion over the next couple of years, easy. And it'll move around between categories depending upon performance. The guys in this space have been huge. I'm sorry, did you have something else to say, Robbie?
No, I think on this slide, like I think you talk about capital raise. Like, is it really true? Top 50 raised 450 billion. Kevin, that's a big number.
I think so. That's a big number. When I came in this space, 100 million or 200 million by a sponsor was a lot of money, you know?
Yeah.
And that was a big name like Merrill Lynch Hubbard or something like that. Nowadays, these guys raise buku money, and you see the list there: Blackstone, Blue Owl, Cliffwater, Ares, KKR, Apollo, Starwood, HPS, Brookfield, Blue Rock in the top 10. And they offer multiple products, right? Non-listed REITs, non-listed BDCs, interval funds, private BDCs, other categories, right? And they're all offering multiple products, because what happens? Something goes out of favor, right? We have non-traded REITs, which are yielding like a 5, and you got BDCs yielding like a 10. So guess what? The money naturally gravitates over there until it doesn't. Then something happens over there, and then it comes back, because you know what? Real estate in my lifetime has been a great performer. You know, it's been a great performer, and it will be again, and it will continue to be if we get interest rates to line up with cap rates a little better. That's all.
Yeah. And on this slide, we talk about the national REIT, right? So it's kind of interesting as well that if you look at on this slide, one's performance pretty well, right? So compared to the unliquid product. The other thing as well, the redemption. Well, the redemption actually pretty high in 23, but it came down to 12 billion, right? So it's kind of pretty consistent to 22 number. Granted, the fundraising have been more challenged, but we'll talk about the execute later on. But this thing a pretty interesting slide as well. They raised net fundraising over the last 3 years, which is a tough year relatively, still 12 billion.
Yeah, I think the interesting thing on this slide, I had more inquiries about this information in the last year from the Wall Street Journal, New York Times, DIYer, Bloomberg, and they all thought this was bad, that this redemption, this is bad. I said, no. This is the best thing ever to happen to this space, because what we're doing is we're testing the legitimacy of that ability to meet those redemptions, right? And they're fundamentally meeting them to the tune of, in 22 was like the first year it popped like this, 12% of NAV. That's a lot of NAV. We didn't have anything like that before. 17% of NAV in 23, 14% this year. So in the last 3 years, $43 billion of equity redeemed in this space. That's gigantic. That's a huge number. And you know what that did? That instilled confidence in all of us. It's okay to come into this space, because you can change your mind, change your allocation, and it's a legitimate part of your whole capital structure for your portfolio, right? To put this in there, get the right asset managers to acquire properties for you, to finance them for you, to run them for you, and then to dispose of them when that was appropriate. But these are perpetual life deals with internal liquidity that is phenomenal. I think this is the best thing ever happened in this space, even though it scares people sometimes that those redemptions are so high. But they built the product, generally speaking, well. They built it with a 20% liquidity sleeve holding liquid securities, fundamentally REITs and other type of securities. They built it with 20% of that kind of exposure. And then as the redemptions piled up, they liquidated some assets slowly. They weren't rushing. They did it slowly, and they kept ahead of that. So for the most part, this industry's masterfully attacked it and delivered on the redemption feature. And that's why we're going to see 175 billion of fundraising this year in this space and grow into 250 billion dollars over the next couple of years. Easy.
Yeah, and then the one thing I hear a lot is BDC. I didn't hear too much, like call it 5 years ago. The last 2 years, especially last year, I heard business development company just skyrocket, right? So in this chart here, it showed 35 billion last year raised on BDC. And exit is about the same. The redemption is about like 2 to 4 billion, have been relatively constant, about 10% of NAV. That's a very interesting one, Kevin.
Yeah, no, absolutely. And it's simple. I think at the end of the day, as they were redeeming from non-traded REITs because of some choppiness on value and maybe the yield on a non-traded REIT's got a 4.5 to 5.5 handle on it, right? In terms of annual distributions, roughly. So people said, hey, you know what? My CDs are giving me 5% now, so I need something more aggressive to make me happy. So what do? They redeem out of non-traded REITs and they put their money into BDCs because the yield on those has got a 10 handle. Right? So it's not complicated. It's pretty easy, right? It's pretty easy. And you know what? They're built the same way. If the market swings again, where interest rates come down, so the BDCs, they're mostly variable rate product, if their yields come down or they have a correction of some sort, then the money will swing back to non-traded REITs, you know? So to me, it's brilliant that these various sponsors put all these different products in their lineup, you know? So they can swing from one product to the other depending upon market conditions.
That makes sense. Yeah, I think the next one, we'll start with kind of basically a second poll, right? So basically, what is the most challenging aspect of launching or managing NTR in today's environment? Is it structuring and regulation? Is it fundraising and investor engagement? Or is it liquidity and redemption? Is it valuation and performance? Or it's not applicable, right? So maybe Deb and Kevin, what do you guys think the most challenging part to managing an NTR today environment?
I would say the first one, structuring and regulatory considerations.
I'm going to go with fundraising and investor engagement. Okay. What people are mostly worried about is how am I going to raise the money? I can hire somebody to help me structure it. I can hire somebody to help me figure out the liquidity and the redemption strategies. And I know I only got to call Altus to get the valuation thing done. So I know that's easy. I think fundraising is the hardest thing for people today.
Okay. We'll wait. Let's see the result.
Okay. Well, I was sort of close. Structuring regulatory considerations, 11%. Kevin, you were right on the nose. Fundraising and investor engagement, 41%. Liquidity and redemption strategies, 8%. Valuation and performance tracking, 6%, and not applicable to my role, 33%.
I'd also add to this, I'd say that the structuring and regulatory part of this industry has gotten a little bit easier because now we can do the same product as a private placement. We can't go to non-accredited investors, but we do it as a private placement, and it makes it easier. You don't have to deal with the blue sky commissioners. You don't have to deal with the SEC in terms of clearing your offering. You may have to file a Form 10, be a Form 10 filer, file 10Qs and 10Ks, but so what? You're going to do that anyway. So to me, at the end of the day, that's gotten simpler. It's not simple. It's gotten simpler. And all my lawyer friends will say, Kev, don't say that. Don't tell anybody it's hard. But I think at the end of the day, that has gotten simpler. And I think the regulators are getting it. They're understanding that making this complex isn't the right answer. Make it better disclosure, better transparency on value, better liquidity. And I'll point out, I think, that our friends at FINRA did a good job a few years back, forcing us to think more about valuation more regularly than we had in the past. And that by pushing us to do that in 2015, it really changed the game. All of a sudden, valuation experts were showing up telling us what these things are worth all the time. We weren't waiting 7, 8 years to figure out what we bought, what it was worth. We didn't have to wait till a liquidation event. We were were hearing about it regularly. So that was a good thing.
Makes sense. Yeah, I think in this slide, Kevin, this is one of the most interesting slides to me, right? So I think for private real estate, there's always about a talk about exit queue. For semi-liquid product, people always worry, how can investor get the money out, right? So, but if you look at this, the redemption queue for the overall industry have been pretty minimal, 0.8% as of now, right? So, and many of them have been no redemptions in last year even, right? So early last year even. So there's only one fund that's kind of relatively large queue, but that's, again, we'll talk about later on, that's part of the exit from 5% to 1%. But generally as well, they're still pretty consistent to the messaging that they said to the investor. They'll address a lot of liquidity and selling the asset as the market return, right? So I think overall, this slide to me to basically show that this vehicle worked, right? So, and I know you talk a little about this part of valuation and stuff, liquidity. And I know NTR already exists, as you mentioned a while back ago. They went into trouble. It used to be flat $10 per share, right? So they went into trouble in 2008. So I guess in here, generally what changed, right? So is it how they manage liquidity, or is it because valuation? They're just trying to get your opinion on what make it change, because some of the stuff you already mentioned as well.
You can't have a conversation about this space without talking about valuation. It's the most important thing. People are scared. They're nervous. They don't know what it's worth. They're giving you their money. They don't know what it's worth tomorrow, right? So they want that consistency evaluation, reputable firm, doing it well. You guys know the disclosure you have to put in those documents. It's unbelievable, right? And you're showing them sensitivities and all kinds of information. So great disclosure and information on value. And then the liquidity, the structure of these deals, they're built to give up to 2% a month, 5% a quarter, which is what we call the cap. They don't have, when they hit that cap, they can stop redeeming, and that's built into the deal. So everybody said, well, how's that gonna go? And a lot of guys hit the caps during COVID, right? They hit the caps, and people were complaining. I said, time out. They redeemed 5%. That's what they said they were gonna do. Let's cheer them on and do it again next quarter, right? Keep going. And that's kind of what happened. And the only guy that got really hung up in any decent sized way was Starwood. And at the end of the day, what Barry Sternlicht did was basically said, hey, you know what? I want to lower my redemption requirement from 5% a quarter to 1% a quarter. But when I do that, I'm not doing it for my own self-interest. I'll take a 20% hit to my fees, okay? So I'm saying, okay, he's manning up. He's manning up. Took a 20% hit to his fees. He gated it, didn't just cap it. He gated it at 1%, not 5% a quarter. And people complained a little bit. He built up a little bit of redemption, but he's got 7-8%. It's nothing. It's small in the scheme of this whole industry. And as you point out, 0.8% of the whole industry is left to open redemptions at the end of the most recent quarter. That's a home run. And that's what got everybody flooding into this space saying, you know what? That product works. I'd put my mom in this deal, right? It's simple. They can get their money out, right? And not any particular deal, but you know, the structure works. And I was a big skeptic at first. I was a big skeptic, saying, "Boy, what's going to happen when we have a run on the bank?" And we had the run. We hit the caps. We stopped. We got noise from the financial press. I straightened most of them out. I talked to them. I said, "Listen, we should be cheering these guys on, not complaining. You know, they're meeting they're hitting the cap and they're meeting the redemptions." And Starboard got a little hung up, but I announced when they made that announcement, they were putting a cap, a gate on it. I told them I would have done the same thing. I would have done the same thing given their situation at that moment. And you know what? They'll work their way out of it. I'm confident they'll work their way out of it. They're smart guys. And that's what you're betting on here with this list of people. They're smart guys. They know how to figure these things out. An interesting name on this list, by the way, I think, is Conan Steers. Conan Steers now has a NAV REIT. A NAV REIT, they're one of the biggest managers of traded REIT securities in the country, right? They're gigantic, tens of billions of dollars of equity in traded REITs, and they have a NAV REIT. Why? Because they think they understand the viability of the structure, that it makes sense, that it works, that it's a good alternative to the traded REIT market.
Yeah, and I think that we'll talk about innovation as what they've done as well. The past 2 years, I know there's a lot of significant pressure, right? Declining NAV, redemption. So we heard about a lot of things. Can you kind of walk through a couple of them? Can I be in here?
Yeah, a couple of them here. You know, certainly when they were looking for liquidity, BREIT was one of the first guys to jump on this structure. And what they did is they went to the University of California and they got $4.5 billion put into a joint venture. They backstopped it with $1.1 billion of Blackstone's equity in BREIT, and they invested the money, the $4.5 billion, into BREIT to provide liquidity. And they're basically just backing that up and putting a floor on what can happen to the University of California. So they backstopped. They put their money where their mouth is. I think that was that showed a lot of confidence to people. The Brookfield guys did the same thing a couple months ago for $200 million, same exact structure, where they put the money up, they backstopped it with some of their own equity, and at the end of the day, they provided some additional liquidity to that REIT. So it's kind of a cool structure. Blackstone also went out and did a financing with the Bellagio. They got $950 million from Realty Income Corporation into a joint venture. And at the end of the day, bottom line is another way to provide liquidity without having to fully sell out an asset. So they were thinking, and they were early. They were early movers on bringing that liquidity to the table. So it was smart. A couple other things that have gone on here. KKR did a shareholder priority plan where they agreed to subordinate $200 million of KKR's equity in KRES, in Crest. And they said, we'll subordinate to investors getting $27 a share, fundamentally giving them a 16% downside protection at the time to NAV erosion, right? People were concerned at the time about NAV erosion. And so they thought that might help stem redemptions. I think it will and does. And they also at the same time put $50 million of fresh funds in for liquidity. Again, putting their money where their mouth is. I think that's always important. Starwood, as I mentioned before, they adjusted their share repurchase program to 1% a quarter from 5%, so they lowered it, and they reduced their fees by 20%. I mean, you can't ask anybody to do more than that. That was huge. And again, they're trying to stem the liquidity issue and take pressure off themselves of selling into what Barry Sternlicht said was a weak market. He thought the market would strengthen over the next year or two. So that's kind of what he did. I think that was a good bet. Ares, as I mentioned before, the publicly registered products are expensive and they're complicated, and you got state regulators telling you what to do all the time. Ares came and said, you know what, we're going to stop offering our publicly registered products, and we're going to convert those offerings into private placements. So we'll sell the same security of the same REIT, but we'll sell it as a private placement, a 506B or 506C, and it'll be less regulatory noise for them. And we'll see how that goes, but we're encouraged by that. We think we're going to see more of that. We've gotten a lot of inbound calls about that strategy. So we think that's going to be something that's going to go on here further. These are a couple big innovations. This space is not short on ideas for something new. We have a thing called founder shares, and that basically is if investors put up a certain level of commitment, they get shares that have a better price on them. They have a lower asset management fee and a lower performance fee for some period of time, for a limited period of time. Those are called founder shares, and guys like Apollo and Fortress and New Haven, which is Morgan Stanley, have already done it, and Goldman and BlackRock are out there with offerings now about to do it. Then after that got going, then they came up with anchor shares. And what anchor shares are is these. If you're a firm and you commit $100 million or some number, $100 million to their fund, when you hit that $100 million, all your share sales of that fund up to that $100 million and after will get a special deal, no performance fee and a lower asset management fee. And the folks at Apollo did it. They raised $783 million. It was brilliant. It was basically giving you an institutional fee structure to the same portfolio, right? Institutional fee structure. So again, and what it allows financial advisors to do is say, hey, invest through me because my firm put their back into this deal and we got a better fee for it, right? That's fundamentally what's going on. Brilliant. And the best part about this space is watching the evolution. And it's like every week, my guys look at that Stanger Digest, which I know, Robbie, you look at. They look at that Stanger Digest and they say, oh my God, look, holy God, we got to look at this. This is something new going on here. We got to change. We got to think through another way to do this. Sometimes we come up with those ideas, but more often it's somebody else and we just borrow it from them, So, but that's okay. It's acceptable in our business.
Yeah, and then maybe Deb, go back to you, right? So I think that not all non-trade REIT create equal. We know some innovation out there. The other thing as well, I saw raised on a lot of non-trade REIT is like more sector focus as well. You saw industrial, triple net, like in some cases triple net called alternative credit as well, right? So multifamily. Any thought about this, Deb?
Yeah, Robbie, actually that's a big one. We've, as you said, not all non-traded REITs are created equal. There's been a notable rise in sector-specific funds, as you said, the industrial, the multifamily, the self-storage, a lot of healthcare. And there's a few reasons for this. Investors are simply seeking diversification. Sector-specific NTRs let investors target what they want, the specific type of real estate. And then some investors believe certain real estate sectors will outperform due to market trends, such as an aging population base driving demand for healthcare, or rising mortgage rates driving demand for multifamily and or, excuse me, self-storage. And as you said too, there's also been an increased interest and competition for, frankly, triple net or net leased assets. There's a lot of reasons behind this. There's stable, predictable cash flows, low risk due to strong tenants, excuse me, and there's a lot of big names out there that you would see that if you saw in the triple net space that are household names. More passive income, so less management intensive. The assets are highly marketable, lending them to be relatively liquid, and lenders like triple net assets leased to strong tenants, so financing can be relatively favorable. So those 5 things, I would say in the last 6 months, we've had a lot of talk about that with the NTRs, but also with this triple net and net lease space. So I'm sure there's a lot more to it.
And Kevin, I think that this on same question. What is the observation, right? So I think this kind of your observation slide in here about the NTR in this market in general.
Yeah, I think yield dominates this space. Always has, right? We didn't pay attention to it when our CD rates were 25 basis points, and you're getting 4.5 or 5.5 out of a non-traded REIT. You said, "Oh my God, this is a godsend to find this," right? Now CD rates are up to 5% or thereabouts. Everybody's looking for something a little stronger, and that's why they flipped over to BDCs and away from non-traded REITs for the moment. But so what? That's just a timing thing, and that will change over time. Private placements, as I mentioned earlier, big force today because you can get to market quicker. It's less expensive and less regulatory interference. The regulators, I think, are getting that. They're starting to write some rules that are a little bit more favorable. But at the end of the day, you're going to see a lot of private placements. It's pretty easy to do it. And part of the reason is there's concentration limits. With the publicly registered products, you can't put more than 8 to 10% of investors' liquid net worth into them. There's limits on how much you do. With private placements, there's no such limit like that. There's not a regulatory limit. So we're seeing that become something of an issue. And then the blue sky regulators, the state securities commissioners, constantly are giving us new rules. They just proposed a set of new rules a couple of weeks ago, and 3 years ago they did another set which were totally crazy. They pulled them, and the latest ones are a little bit better, a little bit less noise, and seemingly are going to be better for the space, I think, at the end of the day. And the reason for all of this at the end of the day is we know we have a lot of redemptions going on. So you have to have a product in there to go pick up that equity when it comes rolling back through the system. $40 billion, give or take, almost $60 billion over the last couple of years. And that's a lot of capital to go find a product that fits. And having private placements, which can get to market faster, you see guys like KKR out there with infrastructure and private equity deals to kind of absorb that capital, give it a place to sit for a couple of years till real estate comes back. At the end of the day, real estate's going to drive this thing when it's all over. When things settle back down, real estate will be the driver because the long-term returns have been good. Our history with them has been really good.
Yep. Real quick, yeah, I think that completely agree, right? So basically, Deb, I think coming back to you, and there's a lot of talk about Delaware Statutory Trust, right? So what is DST? Why DST?
Well, Kevin did say what the DST was, if somebody missed it. It's a Delaware statutory trust. We get that question all the time because the term is thrown out pretty frequently. It's a DST. It simply allows multiple investors to co-own real estate in a trust structure. The DSTs have become more popular in the past few years simply due to a generational shift. These aging baby boomers investors, they need a vehicle for estate planning. And the amount of wealth available to baby boomers is right, anyone, it's staggering. They are the wealthiest generation in history with control of an estimated $73 trillion in wealth. And a significant portion of this is tied up in real estate, with 1 in 4 baby boomers currently owning real estate. So that's a big factor for them. There are numerous benefits to a DST. I'll list them, talk about them. It's a long list, which also gives rise to why they're so popular. Investors hold an interest in the trust. They don't have direct ownership of the real estate. This makes it easier to divide ownership among heirs. Rather than leaving physical assets in wills, which gets a little dicey sometimes, a DST can be more cleanly divided and passed on. I think, as maybe Kevin mentioned, some consider DSTs are less risky in a shaky market, so they're seen as a way to diversify risk and preserve wealth. Investors don't manage the properties. It's done by professionals. It's a passive investment, and this is beneficial as retirees want a simpler life. DSTs qualify as a like kind for 1031 exchanges, which I know is high on the list of reasons why DSTs come about. So baby boomers who have highly appreciated assets can sell their properties and roll their gains into a DST to defer taxes. Investors are protected from personal liability beyond their investment. And last, which is a common reason, access to institutional grade real estate. This gives investors access to high quality, professionally managed commercial real estate they might not be able to afford to manage on their own. So a lot of reasons there, but all of that is the amount of DST conversations that we've had probably in the last 6 to 9 months has been substantial. So we see this growth quite a bit.
For sure, I think this is kind of the high level chart, right? So I think it's the same as what you mentioned, the 1031 to DST. And I kind of look at it as well. This is kind of basically the source of permanent capital to the REIT as well, to the UPREIT 721 exchange, right? So before we go to performance, right? So I know that basically again this DST size, right? So basically they raised 5.5 billion in 24, right? So they raised over $1 billion basically in the 25. If you look at 23, there's only $1 billion something, right? So definitely DST is growing. Before we go to performance side, how big can this alternative on NTR market grow, right? So maybe Kevin, on your thought, like, is it going to be trillion or is it going to be a lot more than that? I'm assuming it's a deep market.
You're talking about non-traded REITs?
Non-traded REITs in general.
We think alternatives in general, we think 175 to 200 billion a year is pretty manageable. And we think NAV REITs, once interest rates straighten out a little bit, we don't see any reason why that can't be 30, 40, 50 billion dollars a year. We think DSTs easily be $10 billion a year. Mm-hmm. We think that's easily $10 billion a year. And the beautiful part about DST, click back one slide if you don't mind. In this slide here, the beautiful part about DST is if I've got an appreciated property, I sell it and I swap it do a like-kind exchange for a DST property, and that sponsor has a REIT, we can do a 721, merge into that REIT, get OP units in that deal tax deferred that are subject to the redemption provisions, 2% a month, 5% a quarter. So my family can liquidate when they choose. When I die, they can liquidate when they choose. They don't have to wait until the whole DST sells a property. They roll into this, get diversification inside the OP underneath the REIT, and then they get liquidity features like the best you can get, right? So to me, that is why this is so hot. It's really a rocket fuel for these non-traded REITs to raise that capital and then ultimately roll it in to the OP underneath the REIT, get diversification and liquidity.
Oh yeah, I think in my mind, I kind of think the same way as well. Like kind of this kind of movement as well. There's a lot of talk about baby boomer retirement, right? So let's talk about baby boomers kind of net worth 76 trillion, about 18 to 19 trillion in real estate, which include real estate investment, right? So, and 1 in 4 have basically real estate investment, right? So, which means that potentially dry powder is in the trillion of dollars, right? So, I kind of look at it as pretty deep, right? So, again, because we're kind of short on time as well, right? So, I'm going to skip a little bit. what's your thought on credit NTR? I know that they don't have same benefit on kind of basically the NAV rate, right? So I know there's a lot of credit NTRs being built up as well in here.
And yeah, I know there's only 1% we had on here that was for credit NTRs, which is interesting because NTRs are, from a credit standpoint, which are, NTRs focus on credit or debt rather than equity, and they're hugely on the rise. And there's a bunch of reasons why. I'll get into the list. Just, it's a long one. Obviously, they offer an attractive yield in a high rate environment. High interest rates, equal higher yields. Credit NTRs invest in floating rate loans or high yield real estate debt, which means in today's higher rate environment, they attract attractive income. This is attractive when comparing to traditional bonds, which we all know have been underperforming. Relatively stable. Credit NTRs have less exposure to real estate price fluctuations since they're not owning property. Debt can be safer than equity in an uncertain market. And, I think we'd all agree the last 6 months or so has probably been uncertain. Unlike public REITs or mortgage REITs, there's no daily market pricing, which appeals to long-term income-focused investors. Credit NTRs have more diversification from traditional bonds, and they're looking to diversify away from traditional, especially given the traditional interest rate uncertainty. So, at the end of the day, credit NTRs offer more stability, less leverage, and are structured for wealth preservation and income, while mortgage REITs are more high risk, high reward. And also, I think, Robbie, yeah, you're right, credit NTRs don't have the same tax benefits as equity REITs. The distributions are taxed as ordinary income, and they have less, they also have liquidity limits and, less upside in a real estate boom.
Makes sense. So yeah, I'll go to the performance side, right? So I think in here, this is also interesting, Kevin, right? So you have this slide in here. I'm surprised when you kind of showed it to me, right? So 39.5% with less volatility. So can you talk a little bit about this slide, Kevin?
Yeah, bottom line is we started doing this about 6-7 years ago. We looked at all the non-traded REITs and we plotted them. And we compared them to the traded REIT world. And guess what? The non-tradeds outperformed the traded REIT world. Hence this is why you see Cohen & Steers in this space. They realize that the traded REIT world is more volatile. It's more volatile. Where NAV REITs are just less volatile. And we know that real estate doesn't bounce around quite that dramatically every day. So it's stable, it's helpful, it's good yields, it's got all positive things, but it's fundamentally outperforming the traded REITs. It'll be choppy. They'll outperform us at some point, but at the end of the day, it showed its resilience over the last several years, and it's been great. It's been a great ride to watch it all unfold. And no, we didn't have this kind of data up until about 5 years ago.
Awesome. And then the BDC as well look pretty interesting, right? So the publicly traded BDC, like which is again the 68.8, and then you got the non-trade BDC 23% number, right? So that seems pretty interesting as well.
Well, the interesting thing here is the traded BDCs have been beaten up and they're recovering. So it looks like they did so much better. They've done better, but it's really off of getting beaten down. I think you're going to see this chart show some nice numbers the next couple of years with the non-traded BDCs, pushing out, annual 10s, 10% yields, which is huge. They'll do that over a pretty long period of time, we think.
Makes sense. No, I know the overall return for both BDC and non-traded REIT look pretty good, right? So I think that also kind of show with no redemption queue. That's kind of proof that the fee relatively as well. Maybe that I think kind of basically there's a lot of talk about skepticism or question about valuation in private market versus public market, right? So, but if you can see from previous slide, the NTR providing stable return, less volatility, right? So, and the current process in place, right? So that basically the fund was able to meet the redemption, right? So, which I mean again for semi-liquid asset, that's pretty good, right? So, and I think Kevin mentioned rigorous valuation process make a big difference. Can you talk?
You don't get that public market, You got professional analysts looking at every property, multiple times during the course of a year versus a Wall Street research analyst looking at it from 30,000 feet. They do a good job. They just can't do the same level of diligence on the properties. I've always thought that the traded REITs should adopt a similar valuation policy. Just why not? It's not that hard to do it. It's not that expensive, and you get a lot of good intel out of it. So I think the non-traded REITs are superior for that reason alone. You get visibility. It's hard to tell what something's worth based upon reported net operating income for 1 year. For 1 year, or 2 years going backwards. You're not looking forward. Where analysts such as Altus, you're looking at 10 years forward or 5 years forward, trying to figure out how these leases are going to roll, right? So it's a lot more better intel and better quality of information, I think. That's my view.
What's your thought on the best practices?
Well, I wouldn't even agree with skepticism, but okay. As Kevin said, we're looking at assets every single month, either ourselves or externally appraised third-party appraisal firms. So every asset, every month gets looked at. This includes hundreds and hundreds of assets each month. So we've got a really strong process in place just to get all of that work done. And we rely on the usual suspects, the DCF, Argus modeling for the income approach, looking at support from market data, insight from each other, the appraisal community, sales and lease comps, data, et cetera. We have our own benchmarking system that we use that I know clients rely on, and that's soon to be Argus Intelligence. We've got our Argus Value Insight, which our clients know as AVI. So for management, communication, and review, that helps tremendously. We're all seeing the same thing at the same time, at the same place. Auditors can take a look. There's a lot of transparency, which I know Kevin's been discussing. The valuations are reviews by our clients, actually making sure the facts are correct, the models are correct. We're doing all these internal controls. So there's a lot of eyes doing a lot of looking and a lot of comparisons. And I think, as Kevin said, that's the one thing that we offer, we as the appraisal community offer this NTRs is just that deep dive, often every month, into exactly what the value is.
Yeah, and then I know that when we do a lot of open-ended fund as well, right, Deb? So any differences on open-ended fund and NTR processes?
Not really. Investment in institutional grade assets are valued the same way, regardless of the ownership structure, the income approach, cash flows, Argus, et cetera. In fact, when Altus first started valuing NTRs, we were using the same general guidelines as we were doing for the open-ended funds because it was a more rigorous process. So we have clients with both, with open-ended funds, with NTRs. The daily is the same, exactly the same. The only thing that differs is sometimes the open-ended funds will have a little more requirements. So requirements from auditors or valuation policy check marks and other specific fund needs. At the end of the day, valuation is still valuation, regardless of what the structure is.
Makes sense. Yeah, so before we go to Q&A, I'm going to address one Q&A. We're going to go to a poll real quick, right? So today's webinar provide you with actionable insight to launch or managing NTR, right? So yes, but need some guidance, and on last one, not applicable, right? So again, from my perspective, this basic webinar from a lot of this data definitely provide a lot more insight, right? So like I said, that any client that basically interested to kind of learn more, definitely do not hesitate to reach out to any of us, right? So basically, Kevin, myself, and Deb, we are here to help. Like, so let's see what the poll indicated.
Right, Rob, you've got results. 28% said yes, 32% yes, would need some guidance, so they've come to the right place, and 41% said non-applicable.
Okay. I'm going to put one question. I know there's multiple questions out there. One question in here that just coming in, maybe to you, Kevin. Is the capital source for private placement different than the public public offering?
Well, yeah, generally in a private placement, you're certainly only dealing with accredited investors, often the same with the public deal, but usually the ticket sizes are bigger and the investors are a little bit more sophisticated looking at it. But they're building them in such a way that they're indistinguishable. They're indistinguishable now. The private offering looks very much like it. They're publicly reporting, even though they're private placements, so they can be indistinguishable, in all honesty.
Makes sense. So yeah, no, we are pretty much max on time. I want to honor everybody's time right here. Kevin, thank you very much for joining this panel. Right, so this session has been very insightful.
Always good talking with you guys, and you're top notch. Whenever we deal with you, it's always a good experience. So
yep. Deb, thank you as well. I learned a lot about insight on policy and valuation process, right? So this definitely will help our client. Right? So I've mentioned to several of our clients, if they're considering NTR, setting up NTR, Please also reach out to Kevin, right? So Kevin is Stanger Group, right? So which again, they're very valuable in the process, right? So please reach out to any of us because Altus have been involved in most NTR out there, right? So lots of companies here to help you and your team reducing your stress, right? So it's a stressful time, right? So take away that stress in here. Thank you for attending today's webinar. Hope all of you enjoyed the discussion and have a great day.
Thank you.